John, so fantastic to have you back here in Australia with us here at ABC Bullion. Obviously a lot to talk about. It's been a record year in many ways for precious metals. I think to end January, gold was up around 5,500 US and almost 8,000 Australian dollars an ounce.
Amazing, isn't it?
Just your view on, I suppose, what were the main drivers over the last sort of 6 to 12 months and then even the main drivers of the correction we've seen in the last few weeks?
You can really point at one thing that's been driving gold over the last 12, 18 months, and that's an increase in investment demand. A lot of people focus on central banks and the central bank buying that's been taking place in the gold market. And yeah, that's been really important. But central bank demand increased in 2022 and has basically been about flat since then, maybe slightly lower last year. So the impetus towards the run in gold came from somewhere else, and that somewhere else was investment demand. Now, I'm sure we'll talk a bit about what's been happening in Australia, but I can tell you from my travels around the world and examining markets, everywhere we saw more gold investment buying last year and into the first quarter of this year than we've seen in previous years. So out of a roughly 5,000 tonne market, there was an extra 990 tonnes of investment demand in 2025. That's why the gold price went up so much.
And was there any particular region? I mean, certainly what we saw here at ABC Bullion and across the Australian market was, in every sense, an unprecedented surge. Was there a particular region or area that stood out, or was, kind of Europe, Australia, Asia, all kind of the same thing?
No, I think it's fair to say that this was mostly an emerging market phenomena and mostly an Asian and Middle Eastern emerging market phenomena. We did see greater volumes in Europe and in North America, but off very low bases. Demand for physical precious metals in Europe and in the United States fell off quite a bit in the last few years, and while they did pick up a bit last year, they weren't the main driver. So if I had to look at countries, China, India, both markets now traditionally are jewellery buying countries, we've seen more investment demand than we see jewellery demand in both China and India. And that's been an enormous change.
What do you think is the driver of that sort of cultural, sort of almost like buying change? Is there a particular thing, or is it?
I think there's two things going on at the same time. The first of which is the gold price is much higher over the last couple of years. That's made jewellery more expensive. People are still buying jewellery. They're actually spending more money on gold jewellery than they were before. But because of the very high price, they're buying fewer items, maybe lighter weight, lower carat in some markets. So the tonnage demand for jewellery is down, even if the dollar value of what they're spending is going up. So that's why we're seeing the jewellery market decline in both countries. On the investment side, I think it's very much been driven by domestic conditions in both cases. This is not about, is the Fed going to cut rates by 25 basis points? In the case of China, very much a lack of other investment alternatives, particularly the weakness we've seen in the real estate market there over the last few years. And in the case of India, I think a lot of it is to do with prosperity and to a large extent momentum. Gold has been a good investment in India for years, partly because of the weakness of the domestic currency, and that's continuing. And gold and silver have seen a lot of investment demand in India. So these markets are changing, they're evolving. I think they're becoming more financially sophisticated as well when it comes to gold. So we're seeing them buying physical gold, the sort of bars and coins that you'll be familiar with, but also through the financial products like ETFs and gold accumulation plans as well.
Obviously, if we were having this conversation on the 30th of January, it would be peak euphoria. The market was just rallying, almost interrupted. Gold sort of $100 a day, silver a few dollars an ounce. A day. It's early May. We've seen let's call it roughly 20% pullback in gold. At one point by mid-March, actually, gold fell down to about 4,100, bounced back a little. Do you think we've seen, or do you think that sort of that pullback into late March was the kind of low of this corrective cycle, or maybe we've got a little bit longer to play out, in the months ahead?
I mean, I think it's the burning question, really. There was no doubt in January, when I think gold was up 30% intra-month, that things were looking a bit crazy, and that a correction was likely at some point. So, okay, we got the correction at the end of January. We've had a second correction, which I think is more associated with deleveraging or profit-taking because of what's been happening with the conflict in the Middle East. Is that over? It's difficult to be certain. There are some signs, I think, of stability coming back into the gold market. We've seen, for example, global ETF flows, which saw profit taking in March, have returned to inflows in April. We've seen the extraordinarily high volatility of gold retreating to more, still high, but more normal levels. Those are signs, I think, that that this corrective phase may be coming to an end. But the one thing that I don't like about the way gold is trading at the moment is it's still in this risk-on, risk-off mode.
Sure.
So when equities are down, gold tends to go down. When equities are up, gold tends to go up. And that to me, it's not uncommon. I mean, we do see it from time to time, but it's unusual. And I would prefer if gold was going back to its own drivers rather than just following what other asset markets are doing. And until it actually establishes a mind of its own again, then I think we are vulnerable for more corrections because I've no idea what's going to happen in the Middle East.
In terms of sentiment, though, then now, it's very interesting. On the one hand, there's a view that, for want of a better term, gold is broken because it sort of fell when the Iran conflict started and it's known as a safe haven. So the expectation is it should have gone up. On the other hand, there are still plenty of investment banks that are very bullish and very publicly bullish, saying, this is just a hiccup and higher prices by end of 2026 are likely. What's your view on that? I mean, in some ways, I would say, maybe sentiment needs a little bit more to reset. What's your view on that? These two sort of extreme bullish and bearish camps almost now for gold.
You have to recognise that when gold has performed so strongly in 2025 and also the start of 2026, yes, there was buying for what I would call sensible fundamental diversification, de-dollarization, debts and deficit arguments. All of that was true. But also there was a lot of momentum that had come into the market as well. Some people were buying it simply because it was going up. And you needed to get that out in a corrective phase, and I think that's what we've generally seen. As to the gold is broken argument, gold tends to do well when equity markets come under a lot of pressure. And the missing ingredient so far of this crisis in the Middle East has been the US equity market remains strong.
Basically, all-time highs and
Exactly.
surging.
I think that gold has held up well in an environment where interest rate expectations have increased, where the risks of inflation have increased, and where, to be frank, the risk of recession is beginning to pick up as well. The fixed income market may have noticed what's going on in the Middle East, but whilst the equity market shrugs it off, I wouldn't expect to see people treating gold as a safe haven, because, to be frank, investors don't seem to think that they need one.
John, we spoke earlier just briefly on central banks, and that's obviously been a recurring theme or area of interest for people watching the gold market. 1,000 tonnes of demand a year there, or give or take, over the last 3 or 4 years. I suppose two questions. One, directly on central banks. Any reason to think that we don't stay around those levels, at least for the next couple of years? But then also maybe moving away from central banks directly, but into sovereign wealth funds and institutional wealth family offices. Your view on how that part of the market might drive demand in the next couple of years?
I think the first question is, what will central banks do over the next few years? I'm comfortable in expecting strong central bank demand to continue over the medium term. There is a risk in the short term, and by that I mean a quarter or two, that we might see a greatly reduced rate of buying and maybe even net selling as a consequence of what's happening in the Middle East. And what happened in Turkey, I think, is a good illustration. So the Central Bank of Turkey sold some gold and swapped other gold for dollars to help protect its economy and particularly its currency markets, because the lira was very weak. There's quite a few countries that are exposed to energy prices and energy supply availability that may come under economic pressure as well. And I wouldn't rule out that some central banks use gold for what it's there for. It's there as an asset which they can deploy. It's not just a pile of shiny bricks that's nice to have, but it's something which is a grown-up financial asset which you can use when you need a source of liquidity. So I wouldn't be surprised if we don't see a few more cases like Turkey, depending on how this crisis in the Middle East continues. In terms of other asset owners, I mean, there's different buckets and different thinking. To me, the busiest conversations I've had about gold in the last few years have been with high net worth individuals and family offices. So people thinking about the long-term protection of their assets so they can hand it down to their children and their grandchildren. In a way, it's a similar sort of time frame to what central banks think of as well, I think. My experience of speaking to family offices and high net worth individuals is they are increasingly concerned about the debt trajectories of the United States and of many other major developed market economies. That's leading them towards holding more gold rather than less. I don't think that changes. Institutional investors so far, they are super tankers. They are huge. They are slow to turn and change that direction. We've spent my entire career at the World Gold Council, which is approaching 10 years now, speaking to institutional investors around the world, and we've had successes, but there's much more success to come. And it's going to take time, I think, for the institutional investment client base around the world to really get on board with gold.
Yeah, it makes sense. I mean, they've got mandates, they've got asset allocation frameworks, they've got regulators to answer to different investment process versus a family office and certainly an individual investor. I think your comment about the way central banks, are approaching the gold market or may approach it in the short term, using it for funding because funding is required, is really interesting and does have a sort of correlation into our client base at ABC Bullion and also just gold owners, private gold owners more broadly. Because I think for most of the last 20 years, people have predominantly been acquiring. And it's almost a psychological battle or thing to go through to say, actually, maybe it's not a bad time for me to sell a couple of ounces. Maybe it's to pay down some debt. Maybe it's because there's a major lifestyle expense that's come up either for you or a loved one. There is actually nothing wrong with selling a little bit of gold or selling a little bit of silver to, deploy it into another asset to spend it on something in your day-to-day life. I mean, ultimately, that's what it's there to help support.
But there's more to it than that, and I agree with everything you said, but think also of the performance of gold and maybe silver if you've had that. You might decide you want a certain proportion of precious metals in your portfolio for all the good reasons. And then you see the sort of performance that we've seen in gold and silver over the last couple of years. And what might have started out at a sensible, 10% allocation, suddenly has turned into a 18 or a 20 or a 22% allocation.
Absolutely.
And, I had a lot of these sort of conversations towards the end of last year and certainly in January. People saying to me, it's like, we bought gold for the right reasons. It's done really well. And now we've got to think about what we do with it here. And, the answer I typically gave was, well, think about why you bought gold in the first place. Has that changed? And the answer is predominantly no. And think about how much gold that you allocated. There's nothing wrong with reducing your position down towards that level. Maybe you think you should have a bit more because of the circumstances that we're in, but you don't have to hold on to it all forever. And I had that conversation with a high net worth individual at an event in London. And I said to him literally, I said, if you had 10% in gold and it's now 18 or 20%, then think about reducing it. And he said, yeah, I've got 80% in gold and silver. And I said, 8-0.
Right.
Yeah, and I said to him, that definitely is worth looking at.
What was the other 20, I wonder? Maybe Bitcoin or something like that. Or
possibly. There were a lot of Bitcoin conversations on that day.
But I think that is really interesting because, again, if I think of the conversations we've had with clients that have sold, a select few are selling because they actually thought, what happened in January was the end of the sort of secular bull market. But much more of it was about, I've made so much money here, I just have to reduce my exposure. I still love owning gold, I still love owning silver, but the sensible thing to do, in their view, given they, to your point, started with X percentage allocation and it was probably double that by January, was just to basically take some money off the table. And I think, one of the beauties of gold and silver, they are liquid assets. They're easy to do that with. They still play valuable roles in portfolios. And I know the World Gold Council recently put out a sort of updated research paper on sort of gold for Australian investors and the like. Obviously, we predominantly serve an Australian client base. Any particular takeaways or insights for an Australian investor that you feel like sharing?
One of the things that stands out to me as I've looked at this research that we produced over the years is it doesn't matter where you're based and what time frame you look at. The suggested portfolio allocation to gold based on historical results has been perhaps 5 to 10%, depending on the country, depending what else is in the portfolio. Australia always is towards the top end of that range. And I think that Australian investors who obviously are exposed to Australia as a country and the economy, and probably have most of their other investments with a domestic bias, because that seems to be the way that it is down here, don't think just because you're long Australia that you're long gold as well. You need to explicitly allocate to gold to get the right allocation in your portfolio. Being long Australia, the country, the market, isn't enough.
John, thanks so much for coming. Look forward to seeing you again soon.